Hey everyone, welcome to the KE Report, a daily editorial with Jim Tassoni, CEO of Armor Wealth Strategies. Now, Jim, you and I talk about a number of different markets. You're a very active trader or investor, so we're looking at some of the short-term moves here, and that gives us a perfect opportunity to discuss what recently happened in the precious metals. A bit of weakness in gold, silver, and the underlying equities about 3 weeks long, where they went almost straight down. Started at the almost start of the earnings season for the major miners and picked up steam to the downside on the back of the election results. However, this morning, Monday morning, we are seeing a nice rebound in gold, silver, and those underlying stocks like GDX, GDXJ on some pretty strong volume. Jim, do you think that that correction in the precious metals is over?
And again, thanks for having me on, Corey. And it's a great question. And as we've talked about over the past few shows and weeks that I've been on, I tend to be more of a momentum trader. And so I don't like to try to pick bottoms or call tops for that matter. And so when it comes to, especially, we'll kind of take it one at a time. We'll start with the gold futures market, the actual commodity itself. And I know when we were on the call the last time, we spoke about this. I guess I would say I said right in that 27.18, 27.20 area, we were flirting with that. I said if we can't hold that level, I would be out of my position and waiting to reassess. I wish I had been smart enough to get short when we broke that level. I did not, but I did exit my position. I stood on the sidelines. We had in the gold commodity futures market, we had a close below a key level for me on the weekly trade. So now I'm actually bearish on the commodity. So I would be looking for a short setup there. But again, I play momentum and I'm not shorting this rip that we have this morning. Maybe it's a good call and maybe there's some good traders who are able to do that. But for me right now, I'm neutral on the position unless we get a daily close below 25.66. If we get a daily close below 25.66, I will be short. Now, the funny part is when we switch over to the ETFs, specifically the GDX, I am not as bearish on the underlying equity ETFs as I am on the metal right now because we didn't get that simultaneous bearish weekly closing on the GDX. I still remain somewhat bullish to neutral to bullish, I would say, on the GDX. But again, I'm a momentum trader. And so right now I'm sort of sitting on my hands. I'm waiting. I would like to actually take a long, but not until we get back above 39.80 on the GDX. A daily close above 39.80, I think targets 42, maybe 42 and a quarter on a short-term pop. That would be the trade I would want to play there.
It's interesting, Jim, that you're a little more constructive on the gold equities than the gold price itself. It's kind of a little bit of a catch-up trade then, even if gold is still consolidating. I wonder how much do you think the U.S. dollar strength or interest rate strength played into the rollover in gold, which all kind of happened on the election results, which also removed some uncertainty and some of the market jitters about what was going to happen post-election. Do you think that all played into the moves we've seen in the precious metals?
100% I do. And I tend to be more price action focused, but I obviously do pay attention to headlines and fundamentals when I'm looking at my overall charts. And I would say that you're spot on with regards to a lot of the fear and uncertainty was sucked out of the market after the decisive win by both Donald Trump and the Republicans in the US elections a little more than a week ago now. And when that happened, I think the other thing that happened beyond interest rates, beyond the dollar, which are both important, is over the past month or two, Donald Trump was seen, as crazy as this is to say, and irregardless of politics, a nearly 80-year-old man is seen as the Bitcoin candidate. And so I think you had a situation where you've seen this massive surge in the price of Bitcoin getting above $90,000. And I think that one of the places that was hurt by that sort of speculation was the gold and other commodity markets, as people were rushing into Bitcoin and maybe unwinding what, if you had been long gold up to this point, was a really great trade, maybe taking some of that off to participate in this raging Bitcoin market.
Jim, what's your outlook for Bitcoin then? This whole $100,000 level that a lot of people have been talking about. Man, we're almost there. That seems like a foregone conclusion. So where does Bitcoin go in your eyes?
Yeah, so and I do not trade. I'll in full disclosure, I do not trade the spot markets in any cryptocurrencies. I do trade the Bitcoin futures. I trade the ETFs sparingly. So I'll stick to the Bitcoin future because that tends to be the area that I'm most experienced in. But we definitely saw when we got that close on the day after the election, November 6th, we got a close in the Bitcoin futures market at 76,875. That was above our breakout level of 74,400. We got long on the open on the 7th, and it's been obviously a really nice trade for us. We do see some resistance coming in here now. We've got about a 3-day resistance starting to form up here at about the 94,000 to 94,100 level. If we can get above and close above that level, I think 100,000 is there within a couple days. And then I don't really have a resistance point there from a technical standpoint, but that's obviously going to be a big psychological level.
Yeah, Jim, a lot of people looking to see that 6-digit Bitcoin possible number there, 100,000 plus. It'll be interesting to see what happens after that and where resistance does come in. Well, we've talked about gold, we've talked about the dollar, we've talked about Bitcoin. How are you looking at bonds? It seems like bonds have sold off as rates have gone higher. Again, maybe some of that uncertainty coming off, but I know you follow the bond market closely.
Yeah, and this is one of our better calls that we've really made all year was on September 18th when we had that first Fed interest rate cut. We were actually on another program that day, and we made the call that we were going pretty heavy short the TLT. We thought just simply because the front end they were bringing down, but we felt that didn't necessarily mean that the longer end of the curve was necessarily going to follow in sympathy. And when we looked at the overall structure of the markets and the economy, we felt that this situation may actually lead to a more normalization of the yield curve. And if we saw that normalization, we could actually see the long end rise while the short end came down to get a more normalized type of curve. And that's exactly what's happened. And we did nail that call. We've taken profits several times in that trade. We still hold a small short in the TLT. We ultimately think that the 10-year yield is going to about 465. We think that's going to be a significant point of resistance. And so we're watching for that level. We continue to hold, like I said, about a quarter of our initial position in short TLT, trying to hit that 465 target that we called out back in September.
Interesting. After that target is hit, do you see something like, let's say, the 10-year going back into the 3% category?
I don't personally. I think we're more in a situation where, and I know this is probably going to upset a lot of real estate investors and people who want to see those lower rates, but I truly believe that we're going to do something that really nobody is calling for, and that's not that rates are going to shoot up to 7, 8, 9% on the 10-year, but also not that they're going back to 2.5%, 3% either. I truly believe that 4.5 to 5.5 range is sort of equilibrium for this market. And I expect more of a chop and a sustained hold in that rough 4.5 to 5.5% range. I think we're going to get there, and I think we're going to stick around there. I don't necessarily see us shooting higher or shooting lower, even with the Fed bringing the front end of the curve down, at least in the short term.
Well, Jim, just to that point, if the rates remain relatively sticky and basically higher for longer because a lot of people got used to a decade plus of far lower rates, what does that do to interest rate sensitive parts of the markets like real estate, like the financials, like small caps? How does that affect some of those other sectors?
Yeah, so I think from that standpoint, it really comes down to the planning and the visibility and clarity around those types of moves. I think it's like anything. I think those sectors got really blindsided. Even though we knew rates were coming higher, we went from 0 to 5.5 on the Fed funds in relatively short order. And those type of moves are very difficult for these sectors to handle. Now we're higher. Their business models are adjusting to that. Their lending needs are adjusting to that. And so I think it's a situation where, as long as they're not baking into their pro formas and their investment strategies a 2.5 or 3% 10-year and borrowing costs coming significantly lower when they're underwriting new investment opportunities on the real estate front, I think that you've got a situation where stabilization could be a good thing because it allows for longer term planning, and it also allows for some underlying fundamentals to come through. And one trade that I actually am that we do have on right now is a pairs trade in the REIT space. We're actually long Simon Property Group against a short in Ventas. And the reason we did that is more from a fundamental standpoint. We think that Simon Property Group is really well positioned. They got hammered through, I mean, they had mall and also multifamily issues as well as office. They were a big office investor, and we know what happened during the COVID pandemic with office properties. So they really got beat up. We like the stock. We like the fundamentals. We think that they're positioned well in the real estate space versus a Ventas, which is a senior housing community developer and manager. And we think that there could be a situation where there's going to be less funding going towards those types of things. I think healthcare and those types of things are one of the things that the new administration is really looking at in terms of, where can we trim some of the fat and some of the bloat in our spending right now? And I think that area may see some headwinds going forward. And the trade's working so far. We haven't been in it that long, only a couple weeks, but we like that pairs trade. It sort of helps us to hedge out some of that interest rate sensitivity and be a little more fundamental within the space.
How about the broad averages then, Jim? There's no denying that they were in uptrends, but last week, maybe that sugar high from the election has worn off because the S&P was down 2%. Small caps, the IWM was down over 4%. NASDAQ down over 3% last week. Has momentum shifted in your eyes?
I definitely see it stalling. When we talked last, Corey, I know we had talked about that area sort of on the SPY right around 585-ish. And we said if we broke out above that, we could see another leg higher. We obviously did, and that turned out to be a nice move to where we are right now. But now we had this move testing 6,000, getting up there, and now we're definitely pulling back into more of a consolidation range. For us now, this area is on the SPY between 595 and 572, and I realize that's relatively wide, but we're definitely not day traders. We tend to take longer term trades when we're putting things on. We see pretty significant resistance starting to form right around 596 in the SPY, but we're still overall bullish. If you're holding a SPY position, we would continue to hold here. If you're looking to add, though, we would not be adding on SPY until we got down into the 572 range and saw a hold there. So we're not, again, going to try to pick bottoms. We'd like to see if we saw a test and a hold of 572, that might be a place where if you've lightened up over the past few weeks, few months as we've ridden higher, that might be a place to add on. As far as like the IWM goes, we've actually been somewhat negative the IWM the whole year, especially in relation to the other underlying indices. And we definitely saw, we weren't short, but we weren't long IWM when we got this huge post election pop. But again, we traded up as high as, I believe, about 242.40 or 242.39. And now we're all the way back down to 229 ish. We're somewhat hesitant to be long IWM. We still think there's significant headwinds in this market. And the index in general, the ETF as it's constructed, in our opinion, is a pretty poorly constructed index in that 40% of the companies inside of that index are actually unprofitable. And I've been managing money for a long time. And if I went to any of my investors and told them I was going to put together a portfolio for them, but 40% of the companies were going to be unprofitable, I doubt I'd have very much luck getting anyone to agree to invest. So we really don't love the index, but we do like some individual small cap names where we can find them.
All right. Very interesting, Jim. I always find it fascinating to hear what you're trading, where you're seeing some of the opportunities, and especially when it looks like we might have had a little turn in some of these markets or a little loss of momentum. But hey, again, Jim Tassoni, CEO of Armor Wealth Strategies. I'll post a link to Armor Wealth Strategies website in the show notes so you all can keep up to date with Jim and what he is trading. Jim, always great having you on the show. Thanks for your time.
Thanks, Corey. Appreciate it.